How banks rigged LIBOR, the shocking truth behind global interest rates. Imagine billions of dollars across the globe being priced based on a single number, an interest rate benchmark meant to reflect honest market conditions. Now imagine that number was deliberately manipulated, not by accident, but as a concerted effort by major banks to tilt the financial playing field in their favor for years. This is the story of the LIBOR scandal, a breach of trust that rattled the foundations of global finance, exposed systemic weakness in market oversight, and cost taxpayers, investors, and ordinary people untold sums worldwide. LIBOR, the London Interbank Offered Rate, was the world's most influential interest rate benchmark. Used to price everything from mortgages and student loans to derivatives worth hundreds of trillions of dollars, it was the pulse of global finance. But behind the scenes, from the early 2000s through 2012 and beyond, this critical number was often rigged by some of the most powerful banks in the world, altering the rate to inflate profits at the expense of millions. Why should you care about a rate fixed in London every morning? Because whether you have a variable rate mortgage in America, a corporate loan in Japan, or a pension fund invested in complex derivatives, your financial fate was linked to this number. And when LIBOR was manipulated, everyone lost confidence in the integrity of the financial system. So, how did LIBOR work? How and why did banks rig it? And what were the consequences? Let's break it down. LIBOR was originally developed in the 1980s by the British Bankers Association, today known as the ICE Benchmark Administration, to serve as a benchmark for short-term interest rates between banks. The concept: every day at 11 a.m. London time, a panel of large global banks would submit the interest rates at which they believed they could borrow from each other in the wholesale, unsecured funding market for various maturities, ranging from overnight to 12 months. The benchmark would then be calculated by trimming the highest and lowest submissions and averaging the rest. This number was critical because it served as the foundation for pricing around $350 trillion in financial contracts worldwide by some estimates from the Bank for International Settlements in the early 2010s. Everything from adjustable rate mortgages, corporate loans, student loans, interest rate swaps, and even sovereign debt securities traced their pricing to LIBOR. The daily submissions supposedly reflected real borrowing costs, providing a transparent and objective market-based benchmark. But the mechanism had a critical flaw. It relied on self-reporting of borrowing costs rather than actual transaction data. Banks were asked at 11 a.m. to estimate the rate they would pay to borrow funds, and there was little verification or regulation. This opened the door for manipulation. Starting in the early 2000s, several major global banks realized they could influence LIBOR submissions to their financial advantage. By submitting artificially low borrowing rates, a bank could appear healthier and more creditworthy to the market during the financial crisis era, reassuring investors and counterparties. More insidiously, banks trading derivatives tied to LIBOR could influence their submissions to push the rate slightly higher or lower, profiting from the difference. Because even tiny changes in LIBOR, fractions of a basis point, could translate into millions in gains or losses on trillions in financial contracts, there was a strong incentive to nudge the rate in a desired direction. Bank traders would coordinate with the staff responsible for LIBOR submissions to achieve this manipulation. Whistleblowers and investigations later revealed organized efforts where traders and submitters traded favors, shared information across institutions, and sometimes explicitly agreed to push rates in ways that benefited their trading positions. It was not just a rogue trader here or there. It was systemic rigging embedded deeply within the largest banks. The first public clues began surfacing in 2008 and 2009 amidst the financial crisis, when discrepancies emerged between LIBOR levels and actual interbank lending rates. Banks no longer wanted to lend freely to each other due to counterparty risk, so real borrowing costs increased, but reported LIBOR rates remained suspiciously low. Some banks reportedly underreported their borrowing costs to hide their financial weakness. In 2012, the scandal exploded into public view when the UK Financial Services Authority (SA) and other regulators launched coordinated investigations. The U.S. Department of Justice, Commodity Futures Trading Commission, CFTC, and the European Commission joined in. The investigations uncovered widespread manipulation dating back at least a decade. In June 2012, Barclays, the first major bank to be penalized, agreed to pay $450 million in fines to U.S. and U.K. regulators to settle allegations of manipulating LIBOR and the related Euribor benchmark. Barclays executives testified that traders and submitters colluded to influence LIBOR rates to benefit derivative positions and that senior management had known or should have known. Following Barclays, more banks faced prosecution and penalties. The U.S. Department of Justice charged several former traders, including Tom Hayes, a prominent trader at UBS and Citigroup, who was later sentenced in 2015 to 14 years in prison after being convicted of conspiracy to manipulate LIBOR. UBS paid over $1.5 billion in fines and settlements. Royal Bank of Scotland, Deutsche Bank, JP Morgan Chase, Citigroup, Bank of America, and others collectively paid more than $9 billion in global fines related to LIBOR manipulation by the mid-2010s. The penalties were not just about money. Beyond fines, these banks suffered irreparable reputational damage. The scandal laid bare a culture of weak internal controls, conflicts of interest, and insufficient regulatory oversight. It forced dramatic reforms in how LIBOR and other benchmarks are set, moving from subjective estimates to transaction-based data where possible. By 2014, global regulators pushed the UK's Financial Conduct Authority and the ICE Benchmark Administration to overhaul LIBOR administration. Plans were made to replace LIBOR altogether with alternative reference rates based on actual transactions, such as the Secured Overnight Financing Rate, SOFR, in the United States, and the Sterling Overnight Index Average, SONIA, in the UK. The transition away from LIBOR was ambitious. It involved renegotiating or rewriting trillions of existing contracts tied to LIBOR, a massive operational and legal challenge. Markets had relied on LIBOR for decades, so the change had to be carefully coordinated to avoid disruption. The fallout affected real people. Imagine a homeowner with a $300,000 mortgage tied to LIBOR plus 2%. If LIBOR was artificially suppressed by even 0.1% for several years, that mortgage owner may have paid less interest than otherwise. But in derivative markets, many entities suffered losses because rates were skewed higher at times. Some pension funds and municipalities with interest rate swaps tied to LIBOR experienced unexpected costs, impacting public budgets and everyday beneficiaries. For banks, traders who manipulated LIBOR sought direct profits, but the damage rippled beyond individual desks. Market trust eroded. Investors questioned whether financial benchmarks reflected reality. The scandal shook confidence in banks that had just survived the 2008 global financial crisis. It also raised fundamental questions about how financial market benchmarks are governed and the risks of conflicts of interest. When the very entities who benefit from a benchmark's level are tasked with providing that benchmark, regulatory oversight is paramount. Today, LIBOR is being phased out. The Financial Conduct Authority announced in 2021 the official end of most LIBOR tenors after June 2023, with some USD LIBOR rates continuing through June 2024 to manage legacy contracts. Market adoption of alternative rates like SOFR for USD-denominated contracts has accelerated dramatically. For example, average daily trading volume in SOFR futures rose from zero in 2017 to over $46 billion by 2022, according to CME Group data. The LIBOR scandal became a catalyst for a broader global effort to strengthen financial benchmark governance and transparency. The International Organization of Securities Commissions, IOSCO, released principles for financial benchmarks after LIBOR, emphasizing data integrity, governance structures, and reducing reliance on unverified estimates. In hindsight, the mechanics of the LIBOR scandal were almost laughably simple. A benchmark dependent on trust and subjective reporting, combined with enormous financial incentives, created a ripe environment for manipulation. But the consequences were anything but simple, touching the lives of millions through distorted mortgage payments, skewed corporate borrowing costs, and damaged public funds. The LIBOR manipulation exposé serves as a stark reminder that markets rely on more than just numbers. They rely on honest participants and vigilant regulators. It also shows how deeply interconnected financial systems are. A rate fixed in London could ripple through pension funds in the United States, corporate borrowers in Asia, and public services in Europe. As global finance pivots to new benchmark rates and tighter regulatory frameworks, the LIBOR episode remains a cautionary tale about the dangers of conflicts of interest, insufficient oversight, and the fragile foundations of trust in global financial infrastructure. The story of LIBOR is a powerful chapter in the ongoing quest to make markets fairer, more transparent, and resilient in the face of enormous economic stakes. At the end of the day, the LIBOR scandal is more than just a financial crime. It is a lesson on the human incentives behind markets, the vulnerabilities of financial systems, and the importance of scrutiny where trillions of dollars hang in the balance. The pursuit of transparency and reform sparked by this scandal is shaping the future of global finance, reminding us all that benchmarks matter, and so does the integrity behind them. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Purdue Pharma: How OxyContin Profits Were Built on Addiction. You will not want to miss it. I will see you there.